All right, I think we'll get underway here. Wanted to welcome everybody here this morning to the New America Foundation, especially those of you who have braved the weather to get in the room. My children were actually convinced we were going to have 4 feet of snow. Snow again. Actually, I still think it's just going to rain, but maybe that's me. I don't know. I'm an optimist about some things and not about other things. Anyway, some people did probably decide to stay at home and watch us over the web at newamerica.net. So we invite those less hardy souls as well, or the ones that are distributed throughout the country. So welcome to all of you today. My name is Reed Kramer. I work here at the New America Foundation. I direct our asset building program, and this is a program that looks at innovative ways to promote social development and economic opportunity. We're concerned about issues of security, about poverty, about economic well-being. And consequently, we often think that there are real limits to the way that we approach some of these issues in more kind of mainstream ways. Oftentimes we take kind of snapshots looking at income at a moment of time. And there's often more value when we have a broader perspective looking out over time, a longer time horizon that I think is more revealing. And when we do that, we see a lot of other variables that matter. Clearly, families matter, parents matter, educational opportunities, other kinds of access to resources matter. We also see that communities matter, neighborhoods, very important as well. So we've long been interested in the dynamics of housing, homeownership policy, especially as it impedes or promotes social development over time. As we know, a lot of people hold their wealth and their debt in homes. And this creates a lot of peril for some, promise for others. And I think that these are important issues to discuss. I think what's also interesting is that homes are where people live. And that often gets lost sight of when we kind of have policy discussions in Washington sometimes. I think one of the coming crises that's related to the economic downturn is the fact that a lot of families are going to be displaced in response to the economic events recently. And I think that there's going to be real ramifications to that, something we need to keep an eye on. So given what's at stake, we're very pleased to have with us today Alyssa Katz, who's going to talk about her new book, Our Lot, How Real Estate Came to Own Us, where she raises a number of these issues in a really compelling way. So we're going to hear from Alyssa. She's going to talk about her book. We're going to get some comments from Ellen Seidman, our colleague here at the New America Foundation. Ellen actually is a housing finance and community development expert. She's played policy roles in the Clinton administration. She was the director of the Office of Thrift Supervision. She's works currently with Shore Bank as well as with us. Anyway, she's got a broad perspective, has definitely some, I think, insightful things to say about the book. We look forward to those comments, and then we're going to have some lively discussion with you all as well. And of course, I'll invite you to purchase copies of the book on the way out. Politics and Prose is helping us sell them here today. And if you do buy one, you're going to get a free packet of cocoa that comes with the book today in honor of the weather. So before I turn it over to Alyssa, I also just wanted to tell you a little bit more about her. She currently is teaching journalism at New York University. She's written for a host of really important media outlets, including some of my favorites like The American Prospect and The Village Voice and The Nation and Mother Jones and The Next American City, a smaller but contemporary magazine that I think is doing a really great job. And she also previously served as editor of a magazine in New York, a small but very important magazine called City Limits. And is it defunct now, or
it's web only,
web
sort
only.
of.
Oh,
yeah.
okay. So it's still going. Anyway, City Limits actually is a kind of journalism that gives muckraking a really good name. It's been very important in kind of the development of in New York City. So that's part of her past as well. She received her BA from University of Michigan. She was a Revson Fellow at Columbia University, which is a pretty prestigious post where I think she looked at some of the issues in this book. And I'll turn it over to her now. Thank you.
Thanks so much, Reed, and Ellen, who was very generous in taking the time to talk with me in the course of researching our lot, and to the New America Foundation, and to all of you for coming in today, despite what we call on Twitter the snow my God. You know, our lot looks at the recent real estate bubble and bust through the lens of this really singular idea that has driven many strands of policy and economics and really national culture throughout the last century, and that is that property ownership is a force for betterment of households and communities, and therefore should be a priority for policymakers. And you know, it'll be impossible to really look at all the complexities of that idea in this brief talk, but I want to focus on a pretty urgent question that confronts us all right now, and that really threatens to get lost in the clamor over financial reform on the Hill. And you know, it's really this question that's very deeply connected to the asset building work here at the New America Foundation of, you know, can and should homeownership continue to be advanced as an asset building strategy for households of modest means? It's an idea that has had a lot of support and force historically, but has lately very much been under siege in the wake of the financial crisis. And interestingly, both from the left and the right. And I think that the conservative critique is pretty much that, you know, it requires strong involvement of government to really make homeownership, widely held homeownership work. It's something that you know, whether through FHA or Fannie Mae or a number of other federal institutions, that is just really a requisite feature. And so I think on that point alone, conservatives don't like it, but there are other ideological reasons as well. You're also starting to see a kind of sense of defeatism, I think, on the part of people on the left who are saying, oh, you know, maybe it's okay to rent. You know, maybe it's not so bad. Home ownership is a burden. It's indentured servitude. And there's definitely a strand of that thinking in my book. I admit to holding on to that. But I think that's also a very short-sighted way of looking at policy, to sort of give up on the entire project and say that it has no merit is really to misunderstand the stakes in situation here as well. You know, what I'd like to do today is really just think about this question rather than just react in the ways I just described. And just to sort of give a brief, you know, rundown of, you know, where this idea of home ownership as a social good came into public policy. You know, this was first accidental and then implicit and then ultimately explicit in the great governmental interventions in the housing markets that grew out of the Great Depression. So first the Homeowners Loan Corporation, then the Federal Housing Administration, creation of Fannie Mae as a secondary market resource, and with them the institution of the 30-year mortgage, which, lest we forget, was not sort of a natural creation, but was very much the product of this government support. And you know, the government was very, very strongly and centrally involved for much of the history of, you know, the recent history of long-term mortgages and the mortgage market that supported widespread home ownership through support of FHA, Fannie Mae, and largely delivered through institutions like savings and loans under pretty strict boundaries, right? You know, regulations on interest rates, on their market activities. The secondary market was pretty much run and managed by Fannie Mae and then Freddie Mac. And in some ways, this worked very well, right, for certain people in certain places. You know, price appreciation wasn't enormous, but it was a sort of form of forced savings for a large number of households a fairly modest means, an appreciating asset. That it was just worked very well for white, predominantly suburban, predominantly homeowners who were served by this system. But the policies that supported this marketplace excluded many other communities through what's known as redlining of many urban areas and the effective exclusion of many potential borrowers, disproportionately African American, from the mortgage market. And this is this major market and social failure that was very directly abetted by government policy. So as I recount in our lot, the tragedy of redlining and its corrosive effects on cities and economic opportunity led to two strands of reactions, right? One was the community reinvestment movement of the 1970s that produced the Community Reinvestment Act, and later requirements for Fannie Mae and Freddie Mac to support home ownership for people of low and moderate incomes. And fundamentally, this was driven by the principle that strong regulation is the way to correct for this market and social failure. So just a little bit after that, but really effectively simultaneously, came a very different approach to the same set of problems, right? Which is that it was a deregulatory revolution that sought to put Wall Street, to use that shorthand, in play in financing mortgages. Through that, bring in new investment capital and new investors to the marketplace, all through the advances in creating securities backed by assets such as mortgages. And in order for this to happen, Congress and the White House had to make some pretty major changes in financial regulation. So a main thesis of my book is that these two strands, one of what were ultimately government and industry efforts to put economically marginal people into home ownership, and then simultaneously the opening of new market opportunities for financial institutions seeking to gain by creating activity in the mortgage markets, generated what was ultimately a very toxic combination. And that the first part on its own likely would not have run into trouble, but it was with the sort of simultaneous imposition of deregulation on a pretty massive scale that the project of using homeownership as a tool for economic and social advancement became threatened, I think, in ways that people at the time didn't necessarily understand. And that basically these efforts to use homeownership as a tool for advancement through many economically vulnerable people into the vortex of lending marketplace that ultimately sought to suck out the home equity they were building as quickly as it was being amassed. And that, in effect, the efforts to promote home ownership as a means of asset building presumed a much friendlier marketplace than in fact existed. And when you look at the subprime mortgage market, both in its 1990s phase and then more recently up until pretty close to the end, it was primarily a refinancing marketplace. These were not loans for home purchase. This was about generating financial transactions based on extracting home equity and giving cash back to borrowers. And we see this phenomenon very explicitly in the research from the Center for Community Capitalism about a very important experiment from the Self-Help Credit Union in the 1990s, which ultimately spawned the Center for Responsible Lending, which attempted to do low-income home ownership responsibly and really give as much support as possible to the buyers. The studies found that a significant number of those borrowers who took out the self-help mortgages ultimately refinanced and got cash back and ended up, and I don't know what happened to all of those borrowers, how many held onto their homes, but many of them took out potentially dangerous mortgages. All that said, I do, and this is after a lot of struggling with this question, right, think that maintaining access to affordable credit for home purchases is an essential public policy goal. So what I want to talk about briefly now is really how do we get there? A few thoughts on this, and I'm really eager to hear Ellen's thoughts on this point as well. One, I think that refinancing needs to be brought under much, much tighter control, right? Because as I said, it was really the mechanism through which so many households quickly extracted equity on terms that were not favorable to them, and really lost the benefits of ownership, pretty much using home mortgage debt very often to pay off credit card debt, right? Because home mortgage interest is deductible. Just weird, perverse incentives that led to very risky behavior on the part of consumers. So one thing I find really interesting is the case of Texas, which is that in the state of Texas, a homeowner cannot refinance their home for more than 80% of its value. They cannot extract cash back from their property above a certain threshold, right? And incidentally or not, and clearly there are many, many other factors in play in the housing marketplace there, but Texas has been very interestingly immune from much of the excess and foreclosure epidemic of the recent bubble. And I'm not quite sure if Texas is entirely unique in its legislation, but I know that this is actually part of the state constitution there, which I found very interesting. I think if Texas can put constraints on refinancing, then I think Congress can too. And clearly you want to balance homeowners' ability to extract equity. That's the point of having the asset and having it gain in value, but the trick is to do it in such a way that thieves basically can't come in and descend on the wealth of economically vulnerable people. So number two, I think that policies going forward need to recognize that moderate income households are especially vulnerable to volatility in real estate prices, right? Even I think more than the typical homeowner. And this just has to do with the nature of where they're purchasing houses, the price range that's affordable to them, and its market dynamics that I think are not unique to the bubble. And the implication to me is that it suggests that we should not push homeownership explicitly, it sort of market it in the way that it has been for many, many years as an asset building policy. The policies may be driven by that as an objective, but to actually sit in a seminar, as so many nonprofits did in bubble markets, telling low and moderate income buyers that this would be a way to make money is just something that's irresponsible, and not just in a bubble environment. And the two examples I encountered in the course of researching my book, I think it's very interesting that this happens both in low-income, quote, inner-city areas, as well as in the new exurbs, right? And they're both the volatility of market values is very much alive in both those types of environments. So, for example, in Atlanta, many, many neighborhoods have just seen insane appraisal fraud, overvaluation that's led to just homes that were valued at $300,000 and had mortgages nearly as high are now selling for less than, I think, $30,000, right? Because they've just gone through these cycles of mortgage fraud and appraisal inflation and so on. And it's just epidemic in many, many neighborhoods. This isn't unique to Atlanta, but Atlanta is realizing it sort of most acutely. And so homeowners there are just severely, severely underwater because of this volatility in prices. But you see the same phenomenon in places like Avondale, Arizona, which is one of these brand new communities, subdivisions built for working people by major publicly traded home builders. And people there are also deeply, deeply underwater, and half of all sales now are foreclosure sales. And it's, so again, they are experiencing price volatility as well. Being in a suburb in a new community doesn't protect them from that. But I don't think this problem is unique to the bubble bursting. I think that volatility is a feature of a marketplace in which capital is fairly deregulated, and speculation is just a very is an inherent feature in so many of these markets. The other thing to be mindful of, and this is a history I talk about at the beginning of the book, but it's a sort of theme that I think will always be with us, is that when a household's worth is very highly tied up in real estate, it can leave households vulnerable not just to equity extraction, but to players in the real estate business who make their living by generating transactions, not just in refinancing, but convincing people to buy and sell. And historically, we saw this in the form of what was known as blockbusting or panic peddling, right? Sort of taking advantage of FHA financing for the suburbs to go to white urban homeowners in the 1950s and 60s, convince them that their property values were going to just evaporate because blacks were moving in, and then quickly got the homeowners to sell for far, far less than their properties were worth, and then turned around and sold them to black buyers for much more money. I think that incentive to generate transactions, and think about how much empty housing stock there is right now and how many hungry real estate agents there are out there, and you start to realize sort of pressures that people are under out of fear that their homes might lose more value, and if they sell, maybe they can limit their losses. It's just another force promoting volatility is people's own psychology, panic over losing the value of their main asset. And three, I think that we really need to keep pretty tight controls on securitization of mortgages, right? And the proposal that I know Ellen has worked closely on from the Mortgage Finance Working Group, convened by the Center for American Progress, recognizes exactly the challenges of shaping the mortgage marketplace and the credit markets to kind of balance the needs of financial institutions to make lending widely economically viable with the ways in which mortgage finance has really incentivized all kinds of really, really destructive behavior, right? This isn't something that the credit markets can solve on their own, but the terms on which the secondary markets operate can have a lot of influence over that. So, to summarize the plan really quickly, it basically would take the core mission of Fannie Mae and Freddie Mac and the GSEs, the government-sponsored enterprises, and give them to a number of smaller chartered entities that would have an explicit government guarantee as well as very specific social objectives they had to meet for financing home ownership widely. And at the same time, other market actors could continue to operate, since, after all, the capacity of government to guarantee the mortgage markets is ultimately limited. So there needs to be some role for non-guaranteed actors. And I think it's a really exciting plan. Where it goes and how it remains to be seen. But I think the one concern on my mind as I think about sort of the importance of creating viable, sustainable home ownership through continued strong support from the credit markets is that as I remain concerned that the involvement of non-chartered players, yes, it will be government regulated under much stricter rules than they have been in the past. Well, pretty much they had no rules in the past, but the issuing of credit securities widely by a potentially infinite number of actors is sort of a task that will be much. It will be a really monumental challenge for regulators to really kind of keep up with all the activity. And as well, there's always the threat of regulatory capture, right? That it's that the regulators who are in charge of really supervising all this activity will basically end up aligning their interests with those of the the credit issuers. But I think overall it's a really, really exciting plan. So, I mean, the other, I think there's another interesting challenge that comes up in thinking about like what policy needs to look like going forward to preserve homeownership as a way to build a stable financial foundation for households with modest means. And that is that we're sort of seeing a really interesting contradiction within the ways that securitization works between one group trying to build assets, right, which is the homeowner, and another group trying to build assets, which are the investors in the securities that finance ownership. You have to remember that not a huge part of the market share, but significant enough of investors in mortgage-backed securities and related securities were pension funds, charities, universities, right? A lot of institutions that are kind of potentially caught in a zero-sum game with the homeowner over sort of who gets to realize the gains from the investments, right? I think there are ways in which policy can address this, but I think we have to really recognize that. And I've been thinking about this a lot as I watch the Financial Crisis Inquiry Commission, where California's former treasurer, Phil Angelides, is chairing the hearings and doing, I think, a pretty good job. But he is there as someone who is an institutional investor, by identification, who has gotten severely burned, as many of them have. And I think that often interests of pension funds like the ones that he helped run align with those of homeowners, but not always. And I think we have to be pretty mindful of that. So I think that the bottom line here is that, just to summarize, we have to sort of simultaneously build a robust and low-risk credit finance system, build buffers around home equity. I haven't talked about this yet, but provide stronger support for renting as an option, and I talk about that quite a bit in our lot, and diversify asset building. And I think that ideas for how to diversify are things that Reed and others here could speak to in much more depth and nuance than I can. But I think it's really essentially about making homeownership one of a range of tools for asset building, and moving away from really making ownership this sort of close to sole repository of household wealth, which interestingly it is disproportionately for minority homeowners, and which has, I think, made minority homeowners particularly vulnerable to very big losses in the market downturn. So one essential kind of corollary to that is I really think that down payments do need to be increased, and just simply because of the way that risk works in the credit markets, but also because a homeowner who is in such has borrowed virtually all of the price of their property, doesn't in fact own it, as they say, renting from the bank, and is in a very vulnerable position if prices decline, because they are extremely vulnerable at that point to foreclosure. And I think we need to look to other asset building strategies to help homeowners acquire funds for down payments. I mean, clearly it's a huge hurdle, especially, let's keep in mind, because federal policy currently is really to keep housing prices as high as possible. I mean, that's the thrust of all the recent interventions, including the tax credit for home buyers, including all the support for purchases on the secondary market of mortgage-backed securities. So, actually acquiring funds for a down payment or being able to afford a home purchase is just not even an option for a huge number of homeowners, and that's likely to be the case for a while. So I think that we have to really recognize that, right? That even if we can agree that theoretically it's a really good public policy goal, that for better or worse in the near future, using ownership as a form of asset building isn't even really an option for a lot of people in many markets, right? I mean, I'm from New York City. I think it's similar in the D.C. area. And, our asset building policies are very skewed in favor of homeowners, right? Starting with the mortgage interest deduction, but there's many other ways as well. And I think that, the other reason that we really need to focus on those who are not owners and are not going to be is that I think that, as much as we sort of think that there's a huge oversupply and overcapacity in the housing markets now, much of that overcapacity is in exurban areas that are very oil dependent. And I think that a lot of the growth of the future and sort of just the economy of the future and the settlement patterns are going to be much more urban core focused, meaning that the price of housing is going to continue to remain fairly high, realistically, for a lot of households. So it just means that we need to really think about, well, what are the asset building policies that explicitly focus on renters? And to have a balanced policy that doesn't privilege renting or owning one or the other. So with that, I'll conclude.
Great. Thank you very much, Lissa. Ellen, let's invite you up to the podium first. You can make your remarks. You want to do it from the stand? And I'll sit here, and then we'll switch, or you can have your seat back.
First of all, thank you all for braving the snow, or thank most of you for braving the snow. Alyssa actually has given a really good talk on housing, but I thought maybe it would be useful just for those of you who haven't read the book to give you some idea of what the book is, and then we'll go back and talk about some of the ideas that she's raised. This book is interesting because it looks at the real estate part of the current disaster from a wide variety of perspectives. The demise of New York rent control, lot flipping in California, equity stripping in Cleveland, mortgage fraud in Atlanta, and the ever less responsible mortgages fueling the ever greater overbuilding boom in California. I mean, it covers it all. Now, I don't know exactly when the book went to bed, but unfortunately there are pieces of it that, even with all that, read like they're a little bit of ancient history. So, house prices have continued to fall. Now, they've moderated some, but they've continued to fall. So when Alyssa finished the book, they were down to 2004. They're now down to 2003. And in Las Vegas, they're down to 2000. So, we're continuing. 30% of homeowners homeowners with mortgages are underwater. And I think most importantly, the book was written before we fell off a cliff on unemployment, with the result that the kinds of foreclosure patterns that we're seeing not only continuing in the low-income communities, and actually there it's somewhat stabilized because everything that could be foreclosed upon has been, but going out into the not just middle but upper middle and the not just subprime but now much more the prime market, even leaving aside the coming problems with option arms, that just hadn't really shown its face to anybody. But having said that, this is really a good, although extremely depressing, read. She is a wonderful storyteller. She does get her sort of New York snark in there every once in a while. Some of the descriptions of some people, I'm a New Yorker too. I could identify, but I suspect that the people themselves might not have. But it forces anyone who reads the book all the way through to face up to the fact that this problem has many sources. I mean, who would have thought that Chuck Percy was responsible for our current problems? But in fact, as Alyssa points out, he was one of the people who figured out that if you could turn the idea that the way to make poor people rich was to let the private market sell them homes, you could get both Republicans and Democrats on the same side of the page. Now, he obviously wasn't totally responsible for everything, But it's, there's a nice, rich historical background here that I think we haven't had from a lot of other folks. I actually was really happy to hear what Alyssa had to say today, because I will say, as I finished the book, the major sort of conclusion I got from it was that renting is good. Now, I will tell you, I am a firm believer that rental is a partial, that the demise of rental as the way we live for a much longer period of our lives, that the demise of that was partially, if not fully, responsible for the problem, and that it is a necessary but definitely not complete solution. So I'm really happy to hear that there are other ideas, and I wish they'd been in the book, because
they're in the afterword. I just wrote it for the paperback edition. Yeah.
Well, thank you. I thought maybe I hadn't read it. Okay, good. I'm glad to know it wasn't there. It wasn't just that I was skipping. Okay, so notwithstanding all of these kinds of these concerns, and I really do recommend it. This is a good read. I thought there were 4 issues that stand out in addition to the one that Alyssa raises here, which I do want to discuss. First is that rental housing and renters really do need a new place at the table. We need to do a far better job at figuring out how we can have affordable rental housing that's of decent quality and has some stability in all parts of this country. And we need to do that for a lot of reasons. If you can rent at affordable levels and not be scared that the landlord is going to raise your prices and throw you out, which of course is the classic situation in parts of the country where they don't have rent control, then you have the opportunity to use the other money to build assets. I mean, one of the reasons why the home ownership thing became so attractive in lower income communities was that you really could demonstrate for a good portion of the population that at the very least, if you just looked at the mortgage plus interest and insurance, I mean, taxes and insurance. If you forgot about taxes and insurance, you weren't playing the game straight. But if you looked at the mortgage plus taxes and insurance, it was not much more than the rent. Now, that is a situation that cries out to me to say, we got to do something about the rent. Because if that's true, then, if you can make the switch without paying a whole lot more, then why shouldn't you? Now, I can think of a lot of reasons why you shouldn't. I mean, the inner city in particular, I disagree with Alyssa on the volatility issue. Actually, yes, there's the gentrification issue. In this last decade, we've gone into a boom and bust situation, but work done by Case and Schiller at the beginning of this decade demonstrated that the lower income, solid inner city communities generally had somewhat less volatility. What they had more of course, was the requirement to spend money on repairs. And so those houses, while they might not have fluctuated very much in value, certainly created an unexpected drain on income, which of course goes to this issue of down payment also, and I want to talk about that in a second. So that's renters. I totally agree with her on the mortgage interest credit deduction. The second thing is that we do have an opportunity to confront issues of land use and sprawl, and maybe we will get it right this time. Now, as Alyssa points out, that dovetails with the issues surrounding affordability. But as many of you probably know, the Brookings Institution and the Center for Neighborhood Technology have developed something called the H+T index, and housing plus transportation, because it turns out that the two have an almost clear inverse relationship to it, that house prices where house prices are low, transportation costs are high, and vice versa. And when you combine that with oil shocks, of course, it gets even worse. So what they have done is a lot of work to map communities against jobs and job locations and things like that, and sort of say, okay, where is the combination less than 45% of income? And we've got to start doing that kind of analysis much more seriously, and then responding to the signals that gives us about not only where we should be concentrating housing, but also where we may have problems of affordability if we do begin to cluster people more effectively. Third, I think she implicitly raises a question about how much housing finance do we really need. So if we stop having serial refis, and if we have more people renting rather than owning, I think the inevitable conclusion is you need less housing finance in the form of churn in the mortgage markets every year. And that raises some questions about whether you can do government support for the kinds of housing finance that you think ought to happen but won't happen in the private market unless there's some sort of government backing to it. And that's not only affordable rentals, but it's things like long-term fixed-rate mortgages with with no prepayment penalties. Whether you can do that in a very, very different scale than Fannie and Freddie turned out to be. And I can talk some about the cap proposal. I will say that to my mind, the two major ideas in that proposal that trump all of the details are, it's the entire mortgage securitization market that needs regulation, not just Fannie and Freddie. This is not a Fannie-Freddie problem. This is a mortgage market securitization problem, and that's different from and on top of the need to deal with the structure of the primary market, the actual mortgages. And then the second thing is the focus on rental housing. Whether it's a 1-unit rental or a 200-unit rental. Although in general the 200-unit rentals do okay, it's the 1 to 50s that are the big problem. And yet that's where the vast majority of affordable rentals in this country really are. And then finally, obviously, how do we do a better job regulating the housing finance industry, including all its parts, banks, non-banks, brokers of all sorts, primary and secondary market builders and renovators. What's the proper role of the federal government versus the state? Alyssa made a very good point about Texas. But, if states are really closer to the action and thus are more likely to intervene earlier as problems surface or have weird things in their constitutions, or frankly have weird things in their constitutions in the other direction. I'm not sure whether that all mortgages have to be non-recourses in the California Constitution, but it might as well be. And yet I think it was a source of a large part of the fact that no one much cared as Californians started putting debt on that was out of all proportion to their ownership. So that what you've got is, if you do want to rely on the states, you've also, how do you protect not only consumers but the entire system when at the extreme the economy, where states are either overwhelmed by forces outside of their jurisdiction, and in Alyssa's book, the clear example is Georgia, but a somewhat less clear example is probably Ohio. Or just choose not to act. And California is the clearest example there, not only in her book, but just in general. Let me comment on a few things that she raised, because in general I actually agree with a lot of what Alyssa has said. I have been pilloried at any number of left-wing events as being, the naysayer on the subject of homeownership for all. I do believe that we need to go back to about 1992. That would be my choice, maybe 95. I don't want to go back to 1980 because there were a lot of people who could not get mortgages who should have gotten mortgages. And I think we actually sort of got it right somewhere along about the beginnings of the 90s to the middle there. I agree with Alyssa that it was this toxic combination that really took us off track. Some of us saw it coming, some didn't. But even those of us who did, and I have read some of my old testimony, I'm pleased to say I did, but we didn't act well enough, and we didn't act fast enough, and we didn't act hard enough, and we didn't, as the bubble that came after the tech boom, by which time I was out of the business, really began to build, did not really work on that. So I agree on the refis need to be brought under much tighter control. That for many years, the cash out refi was not eligible for purchase by Fannie and Freddie. If you're going to have less of Fannie and Freddie being the standard setter, it would be useful to figure out what your alternative is and how you are going to bring this under control. Now, of course, one way of bringing it under control is to improve the quality of the underlying mortgage and also the quality of the underwriting. So, it may be that there are other ways of getting to the same result. On the, let's see, there were a couple of, and we can discuss more of what you said later. I do think on this conflict between, the way she raised this issue of the conflict between homeowners and investors in securities is really quite interesting. I think what's interesting is that in an earlier part of the conversation, she raised this issue of people who make their livings by fees and by churning. That's the third party at the table on the securitization, and it may well be that there's a whole lot more continuity of interest between the investors and the homeowners, and it's all those agents and brokers and churners in the middle who are in fact creating the discontinuity. So I think that's sort of worth talking about. And let's see, I had one more comment. On the increasing down payments, this is a very very tricky problem, because what you want to do is simultaneously, I think, increase down payment so that there's more skin in the game, so that the leverage is lower, so that there's just sort of more real ownership. Of course, the leverage being lower, reduces the asset building nature of this, because don't forget, the asset building nature of homeownership comes not just from good mortgages that are self-amortizing and property appreciation. It comes from the two of them combined with high leverage, which is what we don't have in any other instrument that consumers have access to. And the tension in figuring out how you find the substitute for home ownership as an asset builder is really, at its heart, it's about leverage. It's not about these other things. But the other issue with down payments is that if you take all the money that somebody has saved in a down payment, particularly if it's a low-income person buying an old home in a stressed town, guess what happens? The first time property tax rates go up, the roof leaks, et cetera, they become extremely vulnerable to all of the refi folks. So figuring out how we square this circle, I think, is extremely important. And with that, I will sit down and we'll have a conversation.
Thanks. Yeah, I think what we'll do is there's a lot to obviously talk about. I know Alyssa probably wants to respond to some of Ellen's remarks, but maybe we'll start with a few questions, let her respond. I'll maybe make some comments here and there. along the way. So invite, there'll be a mic that will rove around. I know you get the second question, so you can't have the first one. Jim, why don't we start with you? And you can say who you are, where you're from, and of course your question will be delivered in a very concise, direct manner.
My name is Jim Gray. I'm from NCB Capital Impact. And it may be the bias of the work that I do, but the one thing that I didn't hear was how do we go about fixing the way we do home ownership, especially from Reed's perspective in asset building, so that we could have a more predictable and safe way for people to get into home ownership without having to take too much risk.
Jump in on that. I mean, one model out there that actually I think Reed could probably even speak to in a more informed way than I can. I know just the very, very basics of it is shared equity home ownership. And actually, Reed, could you explain the concept?
Yeah, I mean, actually, it was going to be some of my remarks on looking at alternative ownership strategies. However, Jim is actually more of an expert than any of us.
Okay.
So it actually is a very relevant point. She's invited you to say a few words on shared equity as a concept.
Yeah, well, so this shared equity, it's not maybe the best term because it can mean a lot of different things to a lot of people, but generally the idea is that you have people getting into home ownership where they understand at the outset that they're going to have to resell and not get all the equity back so that we can create a permanent set or a long-term set of affordable housing that can recycle and serve one family after another and allow them to graduate out of that into other home ownership. And this doesn't give the leverage that Ellen referred to, but what it does do is it allows for predictable opportunities for steady wealth creation.
And there's a lot of models, but essentially the subsidy goes in and there is some preservation of affordability. There is still leveraging. It's just less than it would be otherwise. And anyway, there's ways of striking a balance.
Yeah, I think that this issue of way stations between fee ownership and rental actually is important. New York, of course, is one of the homes of that kind of idea. I do think that, and actually the difference between condos and co-ops in New York may demonstrate this at a high income level. I do think one of the issues that we've got to face up to with the limited equity programs, there are two. One is that there's a lot of the term shared equity, limited equity, et cetera, is used for a lot of bad stuff as well as a lot of good stuff. So you just got to get it straight. The second is that the good stuff requires stewardship and requires some entity of some sort, whether it's the co-op board in New York or a nonprofit or whoever, to be in charge of making sure that the property is well maintained, that the residents are thoroughly schooled on what the rules of the game are, because it can be very surprising to them when they don't get that appreciation bump if they're not schooled in it, and to continue to make sure that the turnover is done well.
Yeah.
I'll just jump in on limited equity really briefly. I mean, New York City has a thriving not just co-ops in general, but network of limited equity co-ops, meaning that one can only realize a certain level of gains and no more on the asset value, but also are insulated because of that in some ways against losses. I think the big challenges that we've seen in New York on that are really that one, the system has ended up advantaging people who are cash rich but income poor on their income caps. But what you basically have is a lot of middle class graduate students who get money from their parents and who are buying limited equity co-ops. And it's a real problem within New York system, despite really, really strong local stewardship. And then the other issue with it as well is that you're sort of telling those individuals who are purchasing limited equity co-ops that they are not going to see the price appreciation that someone elsewhere in the marketplace would get. They have to be willing to make that trade-off. And it's a very difficult choice, and one that may or may not be right for anyone in a given place or time. And I think that's a sort of problem in a mixed marketplace to really reckon with. But overall, it's a really exciting model.
Right. Okay. Question number 2 here.
My name's Bert Ely, a banking consultant in town. First of all, I just want to commend you for all of your favorable comments about renting. I'm a confirmed renter, and so I always appreciate people speaking well of that. With regard to how housing is financed and your comments about securitization, which I fully agree with, I was wondering to what extent you've taken a look at the notion of using covered bonds as a financing alternative. Covered bonds have been around in Europe for a couple of centuries now. The covered bonds have provided a very effective way for lenders who make mortgages to keep them on their books, finance them in a very safe manner. This is something that the House Financial Services Committee held a hearing on December 15th. I was privileged to testify at that hearing. But I'm wondering if you've looked at covered bonds as a funding alternative to securitization. Perhaps Ellen has looked at that.
You want me to go?
I will defer to Ellen.
Yeah, this is sort of generally known as the Danish model. We spent a fair amount of time, I guess last year about this time, here working on that, including having one of the governors of the Danish central bank.
Can I just say,
I know it's not necessarily the Danish model. I understand.
The Danish model is actually very different than covered bonds as they're used elsewhere in Europe.
Okay. So I stand corrected, Bert. Thank you. In any event, I do think there are some. I think it's an interesting idea. It's one of the reasons why I think that this question of how big does the mortgage market really have to be is an important one, because while Alyssa tells one story about why Lou Ranieri helped create mortgage-backed securities, Lou's story, at least as he told it last year in New York, is that it was because with the shrinking of the savings and loans and the baby boomers coming of age, there wasn't going to be enough capacity in the banking system to finance all the houses on the books. And covered bonds don't take the loans off the books. Now, the banking system is a lot bigger than it was then. Banks have, the big ones at least, have much. Actually, all of them have riskier assets on their books. But nevertheless, we're financing, at the boom, we were financing between $1 and $2 trillion and closer to $2 trillion of mortgage finance a year. I think this is worth looking at, but I think there are lots of integrated pieces that need to come together, including, I believe, the question of whether the optimal size of the housing finance market might in fact be smaller than it has been.
Okay. Sure, right behind. And then we'll come up here.
Hi, my name is Carl Weichel, and I'm from two perspectives. We've owned homes for the last 35 years, and we would never not do that, so it's in our American DNA. The other perspective, though, I want to talk to is the approximately 33% of Americans that probably never will own homes. I've served on the board of an ecumenically owned housing complex in Northern California that's HUD-sponsored, so I've had the privilege of getting to see how the system works very, very well. One reoccurring frustration that the renters had on the monthly board meetings were, how come you guys get to deduct what you pay for shelter and we don't? American system is built on tax incentives. Wouldn't it simply be easy for federal and state to take that, whatever they're paying, and deduct it? It's going to be a shortfall at some time, but I think that may swing that critical middle mass to enjoy some benefit from renting. And then regarding new housing stock, along that Interstate 80 corridor to Sacramento where all those exurbs were built, they're just sitting there decaying, and our state and federal governments looking at ideas to buy up this stock and take it in a form of Section 8 or other forms in the middle level that it's an interim ownership till they sort that out later on.
Thank you.
I think it's a real long shot at this point for whatever the policy virtues are of giving renters benefits of a tax deduction. It's just going to be a non-starter given the, especially California, right? I mean, the state of government finances right now. But I find it really interesting that the Bush administration convened a commission to study the tax code, and one of their main recommendations was to shrink, or I think it was even abolish, the home mortgage interest deduction, because the deduction does not actually increase home ownership. This is a fact. And what it does is, in fact, make the price of housing more expensive. And it's just basically a big historical accident giveaway. And it's also a political sacred cow. And it's honestly, it's this conversion I've had from the time I started writing the book, being very much of the mind that renting is okay, to coming around to the view that ownership is a necessary part of the mix, is in fact because I perceive the interest deduction as sort of being politically so unshakable that I think it's just kind of scandalous that this benefit would be available to one segment of the population and not the other. And I don't know how you get around that.
It'll be interesting to see people's reaction as you go around and talk about the book and kind of housing in general, because sometimes it's described as being the sacred cow and the politics, and yet this tax reform commission proposed converting it to a credit. Mm-hmm. So it was a complete abolishment or transfer, and it was part of the Obama campaign platform as well. So dropped out of their budget proposals, but still the point being that enough of it was raised on the table. And then, as you're right, if this is really about promoting home ownership, I think we've got pretty good evidence that that's not what's done through the this tax credit. Anyway, it'll be interesting to see what people's reaction to that point is.
Hi, I'm Dr. Caroline Poplin. I'm a physician and an attorney, but I'm not an economist. My question is, it seems to me that the price level of housing is still very high compared to median income, which was stable over a decade or 3 decades and is now dropping. And that maybe the reason for this is that there was too much capital, too many dollars chasing too few goods, and the interest rates were too low. And that one of the reasons the interest rates, well, this is my question, is the government keeping interest rates low in order to prevent foreclosure or in order to keep the assets on the books of the banks at their current level and not force them to take losses?
Oh, gee,
I
think you got to ask our friends at the Fed why they're doing it. I mean, that does tend to have that effect. On this issue of house prices still being too high, I think on a general secular level, the movement really the split between house prices and incomes really started in about 1995. It just got a lot worse after 2001. So that there is room in a sort of general sense for it to come back further. There are places, however, where, it has crashed. I spend a lot of my time in Chicago, in particular on the South Side, and there are parts of the South and West Side of Chicago where house prices are down 50% and still falling. The only reason that you can't tell whether they're falling is nothing selling. And you've got places like Detroit where a house goes for $5,000 or $10,000, and those are actually the ones in good shape. So we can't. I think it's really important not to generalize. On the Sacramento question, the buying up, the neighborhood stabilization program, which admittedly worked better in general, or has worked better in general in the cities than in the exurbs, although there are some pretty interesting variations of it where whole community, a series of communities have gotten together. Part of the theory is that, yes, you would buy up the foreclosed stuff and either tear it down. I mean, in Cleveland, they're going to do some of that. Or turn it into other kinds of housing. It's a very small program. It requires a lot of leverage. Leverage is hard to go by these days. It requires a lot of careful administration and planning, and it'll work in some places and it won't work in others. And then you get to Alicia's point about, and this goes to the H plus T point, is it real? You really want people living in some of those places in the long run, or would we be better to use this as an opportunity to re-densify?
Yeah, no, I mean I would make exactly the same point that Ellen just did about those communities outside Sacramento. I mean, there's a real just question of market demand, whether it's a matter of the policy driving the demand or the demand driving policy. It's a question of whether how much it's really worth investing resources in them, which is a very strange question to ask when you think about literally the idea of abandoning communities, because what does that mean for those who do live there, who do own there? It's a very, very ugly situation. But to get to your question about is there too much capital, I think there's a really interesting problem and question that I admit I don't know the entire answer to. I'm eager to actually do some more research and find out, which is, the policies supporting securitization and of mortgage assets sort of really steered capital into housing to the exclusion of other activities. I mean, this is a point that Sheila Baird made recently in her testimony to the Financial Crisis Inquiry Commission, and it was something that folks who were paying attention back in the 1980s when Louis Ranieri and Congress, were sort of setting things up so that securitization of mortgages could take place on a large scale. We're sort of aware of this. There was testimony from a Federal Reserve Board governor at the time who said, it will take funds out of other activities and steer them toward housing. So I think the question we have to reckon with at a moment of very high unemployment, where clearly sort of the nation's industrial development is in a bit of a shambles and in need of further strengthening, is sort of what are the market mechanisms that really can create some kind of rebalancing. Because much as I'm a housing person and Ellen is, and we all care about it deeply, I think one reason housing remains unaffordable is because people's incomes have remained stagnant, and that's a balancing that has to happen.
And I think although rates are still low, we have seen a change in the process and the number of, what it takes to pull off a transaction. We've seen real sectors of it, like the subprime sector, being changed, not necessarily through regulation yet, but just through conditions. And I think part of what the book raised for me was a lot of the importance in looking at these other consumer protection mechanisms that weren't in place, that need to be in place, that are part of the current debate, and enter into the discussion around creating a consumer protection financial agency or some similar mechanism. And actually, one of the chapters of the book that I want you to kind of talk about here is the subprime chapter. I mean, you read this. I mean, this is crime. This is negligence and crimes were committed, and it's just something that I hope our policymakers and others really get exposure to. So anyway, could you talk a little bit about the subprime experience or the stories that you found in that piece?
Sure. I mean, it's and I found this in multiple cities, but particularly areas, urban areas with older housing stock that were basically targeted by mortgage brokers who were incentivized in many ways to generate just very large volumes of business, and enabled and empowered to do this by lenders and by ultimately the financial institutions that underwrote the mortgage-backed securities. So it was very pretty easy for a long time for a few key actors, for mortgage brokers, for real estate agents, closing attorneys, and very key player appraisers, right? These guys who get paid a couple $100 a shot to say, oh, this property is worth this much, to collude and artificially rig prices. And very often what they would do is arrange to purchase a property and then resell it to other players in the scheme at a much higher price, and then extract the proceeds from a very large mortgage in the process, and then simply walk away. Either they would rent the place out to tenants for a period of time and collect another stream of cash that way, or just not even bother. Maybe they would try to sell it. And so mortgage fraud, more or less along these lines, became epidemic in a lot of parts of the country. It sort of became most notorious in Georgia, but I think in part because players there, community folks, folks in the banking industry, in the real estate business, organized very successfully to call attention to the problem. But it's a really, one question that I get asked a lot, and I don't think is really possible to answer, is to what extent was this kind of criminal activity a driver of the bubble and a driver of foreclosures? And I think that is very, very difficult to determine. But what you do, there have been a couple of really interesting studies, one from a firm called Base Point Analytics that looks at just trends in, it does fraud investigations, forensically, which sort of looks at trends in early payment defaults, meaning that the borrower takes out a mortgage and then stops paying pretty much right away, which is a really good red flag of fraud. And that, I forget the exact numbers on it, but it was quite widespread in certain subprime pools that they were looking at. And I think that's important to think about when we haven't talked about the home affordable modification program and the efforts against foreclosures, but there's sort of this numbers game that the media plays, and I think that Congress plays about like, Bank of America isn't, it's only doing 6%. What's with that? But when you actually look at the different servicers and the rates of modifications they're having, when you look at them. When you look at the servicers that did a lot of that have a lot of the portfolios that were most sort of deeply connected with fraud cases, like AmeriQuest and Argent and New Century and a lot of these places, you see extremely low modification rates, and one would presume, most of those mortgages have gone into foreclosure, but others, these owners that may still have them are just not interested in modifying. This was purely a sort of speculative venture on their part. So it's a real problem, just endemically.
One point that Alyssa made in her talk that I just think is really important to leave us with, and this last question may have sort of sent us off in a slightly different direction, is that while there were definitely problems with home purchases, and in particular home purchases by, quote, people who can't afford, the biggest issues, the biggest problems really revolved around refi, and including the kind of refi that's sort of a home purchase refi, as in the sort of serial move-up. But, I do think that this book does a good job of trying to of responding to it was providing homeownership to poor people that created all the problems. There are times when it gets a little murky, but I think in general the stories that she tells demonstrate that no, it was not providing homeownership to poor people that was at the heart of this crisis.
Yeah, let's take a few more questions. In fact, I wanted to emphasize that point as well about the importance of support systems, because we know that there are some places where we've done well, such as when self-help you mentioned, but Neighbor Works is another place where we've done really important work. So, Ken, grab the mic and introduce yourself, please.
Sure. Ken Wade, CEO of Neighbor Works America, and we're one of the nonprofit organizations that have helped folks, low and moderate income folks, achieve home ownership over the past 20 years. I didn't get a chance to read the book, but I'm just wondering if you thought about addressing some of the positive things, examples where people have done this right. I mean, historically, those of us who've been in nonprofit organizations who work with low and moderate income folks, I mean, it's pretty straightforward. You give people good upfront information about the home purchase process. They get in a mortgage that's suitable to them, and they buy a home that they can afford. If you have those three ingredients, people can be very successful at home ownership. And I know you made a comment about nonprofit organizations maybe encouraging people into home ownership to make money. I'm not familiar that that's one of the things that I know we teach, and clearly it might be a confusion around wealth accumulation versus making money, because those are two different things.
Right. No, fair enough. And I should correct what I said earlier. I think that the pitch was very much one about wealth accumulation, but I still think that's a promise that the prospect of home purchasing couldn't always deliver on in many markets. But that's a really important point. I think a great example of how to do ownership right is in New York City. With the Nehemiah homes, which I don't know if folks here are familiar with it, but it's a home ownership program for people with moderate incomes. Was sort of the one feature of it is that the homes are just very inexpensively built, which is tricky in New York City, and leads to sort of ticky-tacky looking houses, which made me kind of dismissive of them for a long time as sort of a bad, underbuilt use of urban space. But when you actually look at how the financing works on those mortgages, it sort of helps solve that problem I mentioned earlier of the borrowers on the self-help credit union program, refinancing and getting into trouble potentially that way. The City of New York actually has a second lien mortgage that runs simultaneous with the first lien on that. And if you want to do a cash out refi as an owner or do anything else, you have to get the city to sign off on it. And I don't know if at the time that they had envisioned anything like subprime and the subprime refinancing market, but it, I think, proved an enormous bulwark. And what's amazing is that the census tracts where the Nehemiah homes have some of the highest foreclosure rates in the city, but almost none in the Nehemiahs. They're in all the other houses around there, and the Nehemiahs are like these oases of stable home ownership amid disaster.
Great. We'll just take a couple more comments, and then we'll let you have the last word. So up front here, these two. Yeah.
My name is Mark Nadal.
You can wait for the mic's coming right now. There you go.
My name is Mark Nadal. I'm just an independent lawyer. I had a question about a market mechanism that I thought would have kept bubbles from going up as fast in the past and into the future that apparently didn't exist. And that is, if I'm trying to take out a mortgage on a home and it's a house where it sold for $100,000 3 years ago, then $200,000 2 years ago, and now I'm buying it at $300,000, and that's legitimately the market price now. I'm willing to put down 20%, and it seems like I get a conforming, it's a low-cost mortgage. That's the same price as if I bought a house in, say, Cleveland that's been $100,000 for the last 10 years, so it's pretty stable. And I put down 40%, and yet no difference in, as I understand it, the price of the mortgage, even though the amount of risk of losing principal. So my question is, shouldn't there be an element based on the risk that the bank assumes for losing principal that would raise the cost of housing when prices go way up from historical levels, that would tend to prevent bubbles? And I look at auto insurance. They look at all different characteristics of you. But for a house, it's said you put down 20%, and it seems like you get the best rate.
Okay.
Well, first of all...
Well, let's get this other comment, and we'll take it together. Final comment.
Yeah, Charlton, freelance correspondent. First, I just have a yes and no answer. It's mentioned that Next American City. Is this your another book? And also you mentioned that your paperback edition. Is the book here is your paperback edition? And as a prime mortgage transaction, is there a statistic, say how many of them are foreclosure and how many are rescued by Obama action? Yeah. And as unemployment increase, how many of them increase? And actually, prime mortgage. No, this is very important. This is for you. And you mentioned that's a crime. Months ago, I have written an article. I definitely and clearly say that's a crime.
Yeah.
Thank you.
Thank you.
Just briefly, The Next American City is a magazine. It's a national magazine published out of Philadelphia. And it is just really looks at urban development and cities through the lens of what makes cities great and what makes them work. And it's just a sort of wonderful, creative place for discussion around a lot of the kinds of issues we're talking about here around development and what makes a place work. The paperback edition is coming out in July. No, this one is the hardcover, and of course, I would urge you not to wait till July to read the book. And then I don't remember the exact statistics on prime mortgage foreclosures, but they're rising rapidly because of rising unemployment. It's no longer the mortgage features that are necessarily always driving foreclosures. It's now really just the ability of a household to pay at all.
On the stability issue, it's an interesting question. I think, to some extent, there is a pricing on the risk of loss, which used to be, was it conforming or not conforming, and that had to do with the size of the mortgage. Conforming loan limit is so high now that it's, sort of not quite there. I think this is a consequence. What you're talking about is really a consequence of the fact that the mortgage market is is part of the capital market now, and mortgage lenders are price takers. They're not price makers. And so in the old days, the lender in Cleveland would have been a different entity from the lender in Sacramento. Frankly, the lender in Cleveland wouldn't have had any money to lend, but that's a different issue. But they would have priced in their own localities. It is now frankly, a worldwide capital market, and that's one of the reasons why the pricing has not been responsive to some of the issues you're talking about.
Bonds have all different levels: AAA, double B.
They're tranched, though. The underlying mortgage is not at those different levels.
Yeah, actually, Ellen makes a really good point about sort of a lack of local market knowledge really kind of affecting these judgments and underwriting, right? I actually did a piece for the American Prospect a few months ago about this question of, how do you sort of bring local knowledge back into lending? How do you take advantage of the global reach of the capital markets, but sort of the potentially at its best, the stewardship of a local community of stakeholders in really making sure that the underwriting is good and that mortgages perform. And because the current system just has completely broken not just any knowledge, but really any ties or responsibility locally. So I think that the idea that you have there, I think it's sort of a substitute in sort of a, in the absence of that kind of local knowledge can kind of help with that. But I think ideally we bring that set of local players geographically local. Housing is local. It is in a place. Bring them back into the conversation.
Great. All right, well, thank you very much. Ellen, if you could hold up your copy of the book just to show you how interesting this book is. It has not just one or two, but many, many sticky note Post-its. Anyway, there's a lot in there. You can pick up your copy on the way out, and if you purchase one today, you get the free cocoa hot chocolate pack along with it. So thank you for coming, and appreciate it. Okay.